Assalamualaikum and greetings everyone. My name is FARHANA binti MD AZMAN. Today, my groupmates and I will be presenting the answers for past year question July 2021 and an article named Investment Appraisal Techniques of Small and Medium Scale Enterprises in Ethiopia, a case study in selected ward as of Walaita Zone. Firstly, I will be explaining about investment appraisal. So, what is investment appraisal? Investment appraisal includes a decision-making process whereby selecting, evaluating, and analyzing are required in order to determine if the long-term investment should be invested by a firm. We can take non-current assets for an example as the firm usually invests in it. By applying investment appraisal, or widely known as capital budgeting, the firm can determine the profitability of the investments that have been made, as it is expected to provide the firm benefits for more than 1 year, which is known as long-term benefits. Not only that, investment appraisal assesses whether the firm's available capital is sufficient enough to finance the investments and measure its potential value to the business.
Assalamualaikum and hi, my name is IRDINA NAFEESA binti SAIFUL AZLAN. Let's break down this capital budgeting problem about Pure Living Berhad. The company is deciding whether to replace its semi-automatic packaging machine with a fully automated one. We will calculate the initial outlay, annual differential cash flows, terminal cash flow, and then the analyzed payback period and NPV before giving advice. Let's start with part A, one Roman, which asks us to calculate the initial outlay for Pure Living Berhad when replacing the semi-automatic machine with a new fully automated one. The new machine costs Rm 400,000 and the company must also pay Rm 25,000 for installation and delivery. So the total purchase cost is Rm 425,000. Next, because the new machine requires more raw materials, we add Rm 10,000 to the outlay. The old machine was bought for Rm 250,000 and depreciated at 10% per year. After 4 years, accumulated depreciation is Rm 100,000, so the book value is Rm 150,000. The company can sell it now for Rm 160,000, which means a profit of Rm 10,000. Since there's a profit tax must be paid, at 25%, the tax is Rm 2,500. This is added to the outlay because it is a cash outflow. So, the full calculation is new machine plus installation Rm 425,000. Add increase in raw materials Rm 10,000 less sale proceeds of old machine Rm 160,000. Add tax expense Rm 2,500. That gives us a total initial outlay of Rm 277,500.
Let's move on to annual differential cash flow. In this calculation, we have to recognize the benefits and the costs that the new fully automated machine can provide to Pure Living BHD. Before that, we need to prepare two columns that represent 1 year until 3 years for the first column and 4 years until 6 years for the second column. As stated in the question, the new machine is able to increase the company's sale by 30,000 ringgit Malaysia for 1 year until 3 years, and additional 10,000 ringgit Malaysia for the next 3 years, which is amounting to 40,000 ringgit Malaysia for 4 until 6 years. Moreover, the decrease of annual costs for maintenance and defects are 15,000 ringgit Malaysia and 7,500 ringgit Malaysia respectively. Since the question does not state specifically how many years the costs are reduced, we can assume that both periods have the same amount, where both 15,000 ringgit Malaysia and 7,500 ringgit Malaysia are at the first 3 years and the next 3 years as well. The increase in sales and the reduction of annual maintenance and defects costs are considered as the benefit that Pure Living BHD may obtain if the company invests in the new machine. However, there will be an increase of depreciation from the old machine to the new machine. The increments of the amounts of depreciation can be calculated by determining the differences between the depreciation for the old machine per year and the depreciation for the new machine per year. To calculate the depreciation per year, the cost of the machine must be deducted by its salvage value and then divided by its useful life, which will lead to the old machine's depreciation per year amounting to 25,000 ringgit Malaysia, while the new machine's depreciation per year is 70,000 ringgit Malaysia. Then, we can evaluate the difference between both machines' depreciation per year, where there will be an increase of depreciation amounting to 45,000 ringgit Malaysia for both periods. Not only that, the question also mentioned that overhead costs will be increased by 500 ringgit Malaysia per month, with a total of 6,000 ringgit Malaysia after multiplied by 12 months that will be recorded in both periods. The increase of depreciation and overhead costs will be the expenditure for the company if they invest in the new machine. After that, we have to deduct the benefits with the cost incurred for the new machine for both periods, and we will get the earning before tax amounting to 1,500 ringgit Malaysia for the first 3 years and 11,500 ringgit Malaysia for the next 3 years. Furthermore, we have to calculate the earning after tax by deducting the corporate tax rate, which is 25% of the earning before tax with the total amount of earning before tax, where the first 3 years are 375 ringgit Malaysia and the next 3 years are 2,875 ringgit Malaysia. As a result, the earning after tax for 1 year until 3 years are 1,125 ringgit Malaysia, and the earning after tax for 4 years until 6 years will be 8,625 ringgit Malaysia. Last but not least, we have to add back the depreciation amount of 45,000 ringgit Malaysia for both periods, which will then lead to the total for after-tax differential cash flow amounting 46,125 ringgit Malaysia for the first 3 years and 53,625 ringgit Malaysia for the next 3 years. Now, all of you must wonder why we need to include depreciation in this calculation, as it doesn't even involve any cash flows. This is because, even though depreciation does not involve any cash movement directly, it still affects the net profit of Pure Living BHD and consequently the tax payable by the company. Next, we have to find the terminal cash flow as the question required us to do so. Firstly, we have to take the new machine salvage value amounting to 5,000 ringgit Malaysia and sum it up with 10,000 ringgit Malaysia that represents the increase in working capital, which will then the total terminal cash flow will be calculated and equivalent to 15,000 ringgit Malaysia.
Assalamualaikum, I'm NUHA NADIRA. Next, I will explain the investment evaluation using NPV, payback period and profitability index as shown on this slide. First, let us look at the NPV. The initial investment required is 277,500,000, which occurs at year 0. Since this is a cash outflow, it is shown as a negative value. For years 1 to 3, the project generates an annual cash inflow of 46,135. When discounted at 12%, the cumulative present value factor is 2.4018, giving a present value of 110,783.03. For years 4 to 6, the annual cash inflow increases to 53,625. The discount factor for this period is 1.7096, which is difference between 4.114 and 2.4018, resulting in a present value of 91,677.30. In year 6, there is a residual value of 15,000, and after discounting at 12%, its present value is 7,599. After summing all the present value and deducting the initial investment, the NPV is negative at 67,440.68. This indicates that the project does not add value to the company. Next, we consider the payback period. The payback period is calculated by dividing the initial investment of 277,500,000 by the annual cash inflow of 46,135. The result is approximately 6.02 years. Since this exceeds the required payback period of 5 years, the project fails to meet the payback criterion. Finally, we evaluate the profitability index, PI. The profitability index is calculated using the formula 1 plus NPV divided by the initial outlay. Using a negative NPV of 67,440,000.68 and an initial investment of 277,500,000, the profitability index is 0.76, which is less than 1. This means the project does not generate sufficient returns for each ringgit invested. In conclusion, based on all three investment appraisal methods, the NPV is negative, the payback period exceeds the required period, and the PI is less than 1. The company should not proceed with the replacement on purchase of the new machine, as the investment is not financially viable.
Okay, so for the question for B1, for working one, the first one is for the period 0. We have the capital investment for 140,000, and we have sales for period 1 and 2, which is both 130,000. And VC is 30,000 for period 1 and 35,000 for period 2. So we have total cash flow for period 0 is 140,000. For period 1, we have 100,000, and we have 95,000 for period 2. For discount rate, we have 1%, 0.8929%, and 0.7972. So after we calculate all that, we will get 140,000 for period 0, 89,290 for period 1, and 75,734 for period 2. So after we add all these values, we'll get the NPV is 25,024. After we calculate for working 1, we have to find another working 2, which is PV for each item. So we have two periods here, which is period 1 and period 2. So for variable cost for period 1 is 30,000 and 35,000 for period 2, where the discount rate is 0.8929 and 0.7972. After we calculate it, we will get 26,787 for period 1, and we will get 27,902 for period 2. After we add all the value, we will get the present value of variable cost, where 4,689. So for the sales one, we'll get both period 1 and 2 for 130,000, where the discount rate is 0.8929 and 0.7972. After we calculate it, we'll get 116,077 for period 1, and we have 1,306.36 for period 2. After we add all the value, we'll get to 19,713 ringgit for present value of sales and 140,000 for present value of initial investment.
For working street, which is the sensitivity margin, for initial investment, you will need to divide NPV with PV of initial investment, which is 25,024 divided by 140,000. You will get the sensitivity margin of 17.87%. The explanation is the NPV is 17.87% of the initial investment. For variable costs, you need to divide NPV divided by PV of variable costs, which is 25,024 divided by 54,689. You will get 45.76%. The explanation is the variable cost would need to rise by 45.76% to create a negative NPV. Lastly is sales. You need to divide NPV divided by PV of sales, which is 25,024 divided by 219,713. You will get 11.39%, which the explanation is sales will need to drop by 11.39% before the NPV would be negative.
Next, let's talk about small and medium enterprise or SMEs. These are businesses that operate on a smaller scale compared to large corporations, but they play a very important role in the economy. What is small and medium enterprise? Small and medium enterprise, or in a short we call it SMEs, are businesses in sectors like manufacturing, service, trade, and agriculture. They don't have the same size or resources as big companies, but they are flexible, innovative, and often closer to their customers. SMEs can be classified in three main ways: by the number of employees, by the number of capital invested, and by their annual sales or turnover. Based on the classification shown here, a small enterprise has between 6 to 30 employees, while a medium enterprise has between 31 to 100 employees. Based on the article research, according to Tesfaye 2020, SMEs are described as the engine of economic growth in the developing countries. This means they drive innovation, create jobs, and support local communities. In summary, SMEs may be small in size, but they are powerful contributors to economic development. They provide employment, encourage entrepreneurship, and strengthen the overall economy.
So, for the review and summary, this article highlighted a few points, which are: first, poor investment appraisal practices, which is, the article shows that although SMEs are aware of investment appraisal techniques, most do not apply them correctly or fully. Many SMEs rely on simple methods such as the payback period, but they fail to estimate the actual payback time accurately. This leads to wrong investment decisions and increases the risk of business failure. The second is limited use of advanced techniques and PV in IRR, which is another key issue is the low usage of advanced investment appraisal techniques like net present value and internal rate of return. The study found that most SMEs do not consider time value of money, summing discounted cash flows, and comparing rates of return with cost of capital. This weak financial analysis results in inefficient allocation of resources. So for the third one is lack of financial skills and training. The article highlights that many SME operators lack formal education and professional financial training. As a result, they struggle to understand and apply proper investment evaluation of techniques, even though they recognize the importance of investment decisions. And the last one is high failure rate of SMEs. Due to poor investment decisions, inadequate financial management, and weak record keeping, many SMEs fail within the first 5 years of operation. The article links these failures directly to informal business practices and weak investment planning.
We'll explain the investment appraisal process discussed in this article. Focusing on the techniques used and the steps involved, especially for small and medium enterprise (SMEs), first, let's look at the techniques identified in the article. The article highlights both traditional and modern discounted cash flow methods. For traditional method, SMEs commonly use the payback period (PBP). This method measures how quickly the initial investment can be recovered. It is popular among SMEs because it is simple and focused on liquidity. For modern methods, the article discussed discounted cash flow (DCF) techniques such as net present value (NPV) and internal rate of return (IRR). NPV compares the present value of cash inflows and outflows, and a project is accepted if NPV is greater than 0. IRR is the discount rate where NPV equals 0 and the project is accepted if IRR is higher than the cost of capital. Next, I will explain the investment appraisal process steps mentioned in the article. The first step is identification of investment opportunity. SMEs usually identify projects related to manufacturing, trade, or services. The second step is forecasting cash flow. This involves estimating future cash inflows and outflows from the project. However, the article highlights that SMEs often face challenges here due to poor record keeping. The third step is selection of appraisal techniques. Most SMEs prefer using the payback period because it is simple and easy to understand, although it ignores the time value of money. The final step is evaluation and decision making. SMEs apply the chosen techniques and compare the result with benchmarks such as cost of capital, payback, threshold, or profitability index. In conclusion, the article shows that while SMEs are aware of advanced techniques like NPV and IRR, they still rely heavily on simpler methods. Improving financial knowledge and record keeping can help SMEs make better investment decisions.
Next is advice on the action to be taken using the selected decision-making techniques. First is net present value, which uses gold standard for value creation as it considers time value of money. It accepts projects with positive NPV, which as well. The advice is that SME should be trained to calculate NPV using realistic cash flow forecast and appropriate discount rates. The second is payback period, which uses quick measure of liquidity and risk. It favors projects with shorter payback, especially in volatile environments. The limitation is that it ignores profitability after payback and time value of money. The advice is it should only be used as a preliminary screening tool, not the sole basis for decisions. Lastly is internal rate of return, which is IRR. It uses expected rate of return, and the action is that it accepts project if IRR is more than the cost of capital. The limitation is that it can mislead when projects have unconventional cash flows or multiple IRRs. So the advice is to only use IRR alongside NPV for consistency.